This is our presentation on PXD or Pioneer Natural Resources Company with Jared Back, Aaron Stoeckel, and Thomas Smalley. First of all, just a stock overview. The current stock price for PXD is $165.56 with a 52-week low of 48.62 and a high of 166.82. A current EPS of a negative $1.21. So it's Pioneer. It's a American energy company based out of Texas. It was established in 1962, and it was founded on honesty, steadiness, and sweat equity. The company explores for, develops, and produces oil, natural gas, liquids, and gas. Quick business description. XLE, or the energy sector, select sector, consists of companies in the oil, gas, and consumer fuels, energy equipment, and services industries. Oil and gas industry is one of the largest sectors in the world in terms of the dollar value, with about $3.3 trillion in revenue annually. Conservation. PXD is committed to promoting environmental stewardship through their company. Throughout their company, they execute this through their foundational program, Stewardship 365. They have an ESG score rating of 34.7. For environmental, that's 16.8, social is 9.1, and governance is 8.8. Here is their management committee with a few of the heads of the management team, and the entire management team is here as well. Taking a look at the board of directors, just a few people to point out here. And then again, the rest of the board of directors here. Some proxy issues. They have voted on these three things about the last 2 years now. And all three have the board of directors recommended a 4 vote. And that was to vote on an accounting firm, compensation for executive officers, and to nominate 12 directors. Consistency with the Christian faith. This is what they have posted on their values. Is they say when your values are clear to you, making decisions becomes easier, and they execute this through their respect values.
When looking at the company from a SWOT analysis perspective, Pioneer has several strengths. For example, it's known to have a good vertical integration process in place in its supply chain. For example, Pioneer owns Pioneer Water Management Company as well as Pioneer Wells. They're also known to have a high quality training program, are reliable suppliers for their raw materials, which is very important within the industry. And over time, they've built up a very reputable and ethical brand. They do have some weaknesses, however. Despite having this high quality training program, they're known to have a high attrition rate to train their employees and spend more than many of their competitors on training programs. They also have a high day sales inventory and a limited market share with several of the products that they produce. Some opportunities that may be apparent to Pioneer is the growing trend toward e-commerce and an expanded online presence, as they're currently yet to establish a strong online presence, as well as government legislation moving forwards towards renewable energy sources such as tax cuts or subsidies. Some threats that are imminent to both the company and the industry itself is the limited supply of oil and other natural resources that they obviously rely upon, as well as any technological developments made by competitors. From a 5 forces framework perspective, the threat of new entrants in the industry is very low. This is due to the high investment required to enter the market and market leaders utilizing economies of scale. There's also high government regulation to enter the market, and the threat of entrance really comes from within the industry in terms of innovation. For example, the development of more efficient production processes in generating energy. The threat of substitutes is moderate, as there's a global trend towards renewable energy. However, at this current time, there's very few alternative products available in terms of energy. The bargaining power of suppliers is also very low, as there's several suppliers in the industry and they have a relatively standardized product, meaning it's a low switching cost. And specifically to Pioneer, there's a very minimal threat of forward integration. The bargaining power of buyers is also relatively low, as few firms actually supply the product and buyers rely on a high quality product. Rivalry in the industry itself is moderate, as although there are only few firms, many of them have a large market share, and there's high exit barriers, meaning companies would be discouraged from leaving the industry. Just a quick look at the economic model. The energy industry operates somewhere between a monopolistically competitive market and an oligopolistic market. This is because there's two main leaders in the industry, Exxon and Chevron, having a large market share, as well as several smaller companies such as EOG and Pioneer that have a market share somewhere between 3 and 5%. The market cap of the industry itself is $9 billion, and the industry is known to be very volatile and was heavily impacted by COVID. However, there's high potential future growth as technological advancement continues. On the screen now, you'll see the correlation matrix. Some notable values to point out here is that although the industry itself has definitely underperformed recently, Pioneer itself has a better annual rate than its competitors and the sector, and it also correlates far more with the sector than its other competitors, which would be promising given that analysts expect the energy industry to grow.
So transitioning into the financial analysis section, just touching on the ratio comparison, I just want to point out how they were in 2019. Their ratios were much healthier with both liquidity and efficiency, with having their current ratio and quick ratio below 1. And then in 2020, they had to take on a lot more debt, which made their ratios have to go above 1. However, we're optimistic for 2021 being a year of recovery and having better profits, and having these current ratios and the quick ratio numbers decreasing in 2021. Common size balance sheet, just to touch on a couple numbers here. A lot of their assets are in net PP&E. I think it's pretty common for a lot of companies in the oil and gas industry because they have a lot of their assets in their oil plants and such. I just wanted to point out that their net PP&E didn't change or decline all that much from 2019 to 2020. So they were still able to keep their size in terms of their oil plants, and they didn't have to sell off a lot of it. And then, like I mentioned, with their long-term debt, it went from 0.964 to 16.43. So, like I mentioned, they had to take on a little bit more debt in 2020. Their common size income statement, again, like I mentioned, in terms of their revenue and their costs, revenue kind of went down and their costs went up, creating a gross margin of 11.79% compared to past ratios, which is around 20 to 25%. Again, I think 2021 will be a more optimistic year and will recover more to where the gross margin will be again around 20 to 25%. Sales forecast, with the sales from the past 10 years, we got an arithmetic average of 14.18% and a geometric average around 10.21%, forecasting about 8,900 of sales. So for our EPS forecast, we're projecting around 25% growth with sales, ultimately giving us an EPS of around 5.68. So here's our valuation models. The one that we mainly relied on was the supernormal free cash flows, experiencing some growth and then evening out a little bit, and then ultimately experiencing some steady growth of 6.25%, which gives us a target price of $179.69.
When speaking on the investment risks associated with Pioneer, from a regulatory perspective, there's increasing safety and health requirements within the industry, both domestically and globally, where they source the majority of their oil. They also may be subject to increased tax on high emission non-renewable fuels with the coming of the Biden green administration. From a consumer taste perspective, as I mentioned previously, there's a trend towards renewable energy. Leading on from this, industry leaders have had a higher investment in R&D than Pioneer, which may mean that they not be able to meet the increasing demand for a low-cost product or move into the renewable energy sector. From a scenario analysis perspective, a good case would be that this growth seen by the stock continues and Pioneer better integrates into the expanding renewable market and markets that they currently operate in. A worst case scenario, however, would be that this volatility leads to an assumed overvaluation of the stock and Pioneer is unsuccessful when investing into new R&D production methods.
With the current price of 165.56 and a target price of 179.69, our group issues a buy recommendation of 20 shares for a total value of $3,311.20. And lastly, here are our resources.